Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Edding Genor Group Holdings Limited annual report. Edding Genor Group Holdings Limited offers a diverse range of businesses and services across various industries. In the biopharmaceutical sector, the company develops and distributes products such as GB491, a CDK4/6 inhibitor for breast cancer treatment, GB161, a bispecific antibody for autoimmune diseases, and trispecific antibody candidates GB263T and GB168. In addition to its research and development of biopharmaceuticals, Edding Genor Group Holdings Limited also provides a variety of established pharmaceutical products. These include vancomycin for multi-drug-resistant bacteria, Secler for bacterial infections in children, Uroe-Ping for nebulized inhalation therapy, Vascepa for cardiovascular risk reduction, and Molpleta for reducing bleeding risk. The company's product portfolio extends to oncology, autoimmune, cardiovascular, respiratory, and anti-infective therapeutic areas. Furthermore, Edding Genor Group Holdings Limited is involved in marketing, commercialization, and trading of pharmaceutical products, research and development of respiratory products, and consultancy and promotion services. Edding Genor Group Holdings Limited market capitalization of $5 billion is materially smaller than most of its industry peers of roughly $26 billion. Edding Genor Group Holdings Limited trades at a higher price-to-earnings ratio of 36 times and a lower price-to-book ratio of 0.44 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The primary drivers of revenue growth for a company can be attributed to several key factors. Successful mergers and acquisitions, such as the completion of a strategic merger, can lead to significant revenue increases. Additionally, regulatory approvals, including those from the National Medical Products Administration, NMPA, can also contribute to revenue growth. The inclusion of products in the National Reimbursement Drug List, NRDL, is another crucial factor, as it enables patients to access these medications at a lower cost. Furthermore, clinical trial approvals and new product launches can drive revenue growth. External collaborations with other companies can also lead to increased revenue through shared resources and expertise. The sales of both originator-branded products and innovative products contribute significantly to revenue growth. Finally, the development and commercialization of oncology and autoimmune drugs business can also be a major driver of revenue growth. On the other hand, there are several factors that can drive revenue decline. For instance, if certain products, such as vancomycin or Molpleta, experience market adjustments or decreased demand, it can lead to a decline in revenue. Additionally, if a product is not included in national centralized drug procurement lists, it can also impact revenue negatively. The slowdown in antibacterial drug markets and the decrease in service income due to high base effects from previous years can also contribute to revenue decline. The net income of a company experienced a decline between 2024 and 2025, decreasing by RMB 21.1 million. This reduction occurred despite an increase in profit margins, which rose from 67.4% in 2024 to 68.2% in 2025. The improvement in profit margins can be attributed to the growth in gross profit margin, indicating that the company was able to maintain its pricing power and control costs effectively. However, the decrease in net income suggests that other factors such as operating expenses or revenue growth may have offset some of these gains. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the operating cash flow figures provided on page 43 and page 50 of the report, the company has consistently shown positive operating cash flows. On page 43, it is stated that the operating cash flow before working capital changes was RMB 808,102, which already suggests a healthy financial position. However, what's even more impressive is that this figure increases to RMB 885,736 on page 50, indicating a substantial growth in operating cash flow. This positive trend in operating cash flows is a clear indication that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in future growth initiatives. The company has experienced significant changes in its debt level and interest expenses over the past year. In terms of debt level, interest-bearing bank borrowings have decreased substantially, dropping from RM 1,993.1 million to RM 1,065.7 million. This decline is a positive indicator for the company's financial health. The decrease in interest-bearing bank borrowings has also contributed to a reduction in total debt level. The company's ability to manage its debt and reduce its overall liability is a testament to its financial discipline. In addition to the decrease in debt, the company has also seen a significant drop in interest expenses. Interest expenses have decreased by 45.6%, from RM 154.6 million to RM 138.5 million. This reduction in interest expenses will likely have a positive impact on the company's bottom line and profitability. However, it is worth noting that refund liabilities, which are interest-bearing, have increased slightly. Despite this minor increase, the overall trend of decreasing debt level and interest expenses suggests that the company is making progress in managing its financial obligations. The company's performance can be analyzed through its various segments. The manufacturing and distribution segment stood out as a strong performer, indicating efficient operations and effective supply chain management. On the other hand, the research and development segment struggled, resulting in a significant loss before tax of RMB 357,595. This disparity highlights areas where the company excels and those that require improvement. Management has outlined several key developments that will shape the company's future. Notably, a significant acquisition and reverse takeover with Edding Group Company Limited has been completed, paving the way for new opportunities through a listing application. Additionally, management is prepared to mitigate potential risks by considering hedging strategies for foreign currency exposure, if necessary. The company's financial statements are expected to remain unaffected by upcoming changes to accounting standards, providing stability and continuity in its reporting. These strategic moves demonstrate management's proactive approach to navigating the business landscape and positioning the company for growth and success. The company's financial history reveals a commitment to shareholder value creation through various means. One notable aspect is the payment of dividends, which demonstrates the company's intention to distribute profits among its shareholders. A specific instance of this can be seen on page 47, where it is mentioned that a special dividend of RMB 46,485,000 was paid in 2025. This payment of dividends indicates that the company has prioritized returning value to its investors through direct distribution of earnings. By doing so, the company has shown its confidence in its financial performance and its ability to generate sufficient profits to reward shareholders. Concerns about inventory buildup and supply chain disruption have been raised due to several factors. Firstly, the company has experienced a significant decrease in inventories from RMB 552.8 million to RMB 432.3 million over a certain period. This reduction in stock levels may indicate that the company is struggling to manage its inventory effectively. Furthermore, there are concerns about the write-down of inventories to net realizable value, which amounts to RMB 21,851. This suggests that some of the company's products have become obsolete or are no longer saleable at their original price. Additionally, impairment provisions made for certain products approaching expiration dates amount to RM 18.3 million, indicating potential losses due to supply chain disruptions. The decrease in cost of sales and selling and distribution expenses in 2025 compared to 2024 may also be a cause for concern. This could indicate that the company is experiencing difficulties in managing its supply chain, leading to reduced efficiency and increased costs in the long run. Overall, these factors suggest that there are valid concerns about inventory buildup and supply chain disruption within the company. That concludes the financial summary for Edding Genor Group Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.